And finally, part two, a venture stock valuation by FCF model, the free cash flow of the equity model. Unlike the free cash flow of the firm model, we directly calculate the free cash flow of the equity. So here we reconcile net income, right, by adding back this depreciation and increasing net operating working capital and capex. Here we have increase in net debt issue. That is also one of the cash flow that melted into the asset investment of the company already, right? And then we calculate excess cash or the additional funding needed. Here we don't have interest expense here. We only consider the equity value directly because net income is the shareholders' benefit, right? And as we discussed during the class, we need to calculate horizontal value at the year 2026, the last year, or the terminal value or permanent value, considering this is 7% of the projected sales growth rate of 2026 is the permanent growth rate. And then we'll sum all these cash flows up, including this horizontal cash flow. And then we calculate this present value of the venture by discounting that free cash flows by the cost of equity. Cost of equity at the startup stage in 2021, as of today, we use high percentage of cost of equity, right? Which is the nature of the borrowing cost in the market, the ventures market, private equity market. So as indicated in the descriptions, 20%, 40% is the appropriate discount rate if the company is the startup life cycle stage. But once the company survived, some companies survived and will become a more typical firm like maturity, the early maturity stage company or IPO company or the seasoned firm. So we have the 20% here. So let's go. Net income everywhere here. Here net income and the net income on the cash flow statement doesn't matter. So we got this, right? And the depreciation add back, we already calculated here, right? As well. Then, because what we are calculating is free cash flows, definitely can get from the cash flow statements as well. The increase in net operating working capital, you have to be careful here. When you measure the current asset and current liability, net operating working capital is current liability and current asset minus current liability, right? But what we want to calculate is increase in net operating working capital between 2 years, right? So you need to remember this change in net operating working capital. Second, you must exclude excess cash amount if there is excess cash amount, which is actual free cash flows, right? Because it's not part of the working capital, right? It is generated by the cash generated by the business. Just it can be viewed as like a pseudo dividend, right? Which is the shareholders' actual the benefit, right? So how to get it? Let's go. Here, open the parenthesis, go to the balance sheet. There you go. Here, required cash. Oh, before calculating this, what we want to calculate, increase in, right? Again, here, increasing in, then we need to start from, right, old to new, right? So here, and plus, then the accounts receivable, right, plus the inventory. Again, remember, we do not include the excess cash. It's not working capital. And minus, let's move to the liability, right? And minus, that is the working capital, right? Net working capital in year 2021, right? But what we need to calculate is increase, right? So open the parenthesis one more time. The year, next year, so that a small starting from small amount to the bigger amount, and then we can get increase, which is negative, right? Again, we put all this value plus, then minus, let's move to the liability. And the bank loan is not working capital, right? It's a kind of the financing, right? So we do not include this. And then we got this increase in net operating working capital. Yeah, negative 100. Let's just drag. Once you understand the concept of working capital, and then you put the right the equation, and then you can just drag. Increase in capex. Now, increase in capex. Where is the increase in capex that we already calculated? There you go. Right? So we just link this from the cash flow statement, and then we collected everything. Then increase in net debt issued. Again, the increase in net debt issued is if the company already issued net debt, and then that is not the part of the addition of the funding needed, right? Additional funding needed means the company now borrowed money, and then they need a more capital, right? Because they want to, they need more capital because the total asset they invested for the projections is greater than total liability and equity, right? So that's why net debt issued is also part of the cash flow. If the company has been the borrowing that amount from new debt that is already melted, that would be already melted into the asset investment. Do you have the increase in new debt issued? I don't think so. Here you go. There's no debt changes, so let's just drag. And then annual change in free cash flows. Finally, we just sum those up. Then let's drag to the right. So remember here, the first year and the second year, definitely this is negative because the company, right, had change in new common stock, which is AFN. AFN, that means that doesn't create any. The company didn't create any the excess cash, right? Excess cash. So definitely it is negative. But once do you see this 595, which is the same as, right, the excess cash amount, right? And then this 2,299 is the difference between these two, increased amount of excess cash, right? Okay, it can be distributed to the investors in the form of the dividend. But here, what we are calculating is the value of these ventures, right? Value of these ventures before the distributing or before the financing, additional financing. So we want to calculate here actually the value of the company based on the cash flows. And then you also have to be very careful here. The last year must be positive, right? Annual changes. Why? Well, oh, this is the venture. Yeah, venture cannot make a cash in the future. But the projections we are making is 2026. That means you already passed this survivor stage, right? We passed already. Now this is not the development stage or the startup stage or survivor stage. This is the stage early maturity stage or the rapid growth stages. On that stages of the life cycle of venture, the venture must create cash, right? Then we have cash here at the annual change in cash. Second reason, the last year balance, last year annual changes in the free cash flow must be positive is that we need to project the horizontal cash flow, right? The present value of the future cash flows, right? Discounted by the cost of equity at early maturity stages, right? Early maturities or the rapid stage, the rapid growth stages. Then we have to get the positive value using the golden growth, the discount model, right? Constant growth discount model. And then this amount must be increased by permanent growth rate, right? And then divide by, now what we want to use is the discount rate, right? Where is discount rate? Okay, this early maturity stage. I want to put this first, and then minus one more time the growth rate, right? Permanent growth rate. So, we don't have a value yet because I haven't put. What was the cost of equity at early maturity stage? Yeah, 20% on the description. Then the cost of equity at startup stage 2021 as of today was 40%, right? Now, so we got this present value of year 5 2026 of the permanent cash flows, right, based on the DDM model. Okay, and then we have some of all the cash flows of each year. Then we have this free cash flows. This free cash flows for the projected year is including not just the not only 5 years the free cash flows, but also permanent value, permanent cash flows of the venture, right? That is calculated in 2026. The horizontal the value is one of the cash flows of this venture. And then present value of venture, what we are using is net present value. The rate at the current time is cost of equity, right? Here, startup stage today. And then comma, and then drag all the future cash flows, right? Then we got 4,152, 4 million actually, because these all numbers are thousand. And then the number of shares outstanding, which is a given, right? Here, 1 million shares, which means 1,000, right? And then we divide this. We got the per share, venture value per share is $4.15. That is the stock value you will provide you'll provide the venture investors, right? Okay, that's all, guys. Bye bye.